nobody was wanting to invest in the areas he was investing in. We're talking about C and D class areas of Southern Dallas. And then how do you make money in those areas? So most people would just do a quick flip. But for him, it was about how do we provide ownership access to people that don't have it. I think anybody listening, it's important to note that we're as strong on our impact side as we are as our investment side. And we believe when you can combine both of those things, that's really when you can do special work. If I was going to say one message of our investment thesis, it goes back to the supply-demand imbalance of quality workforce housing. And so for people that are coming on and wanting to buy a home or entering those home buying years, it's very difficult and it will continue to be difficult for them. So what is the solution?
Hello and welcome to the Masters of Real Estate. Today we are going to learn from Jordan De Silva. Hey Jordan, how's it going, buddy?
It's going well. Good to see you.
Yeah, likewise. So Jordan, how do you introduce who you are and what you do to your target audience?
For sure. So WebCity Properties, we've been around since 2005, focused on workforce housing here in North Texas. We specialize in single family rental properties, multifamily, and small developments. Vertically integrated with 10 employees. We have over 500 units of housing, overall 60 million in assets under management. And we're excited and focused on providing attainable quality housing to working class families.
Wow, so it seems like you've done quite a lot with Web City Properties. So right now, would it be accurate to summarize your assets under management as 500 units? So what is a dollar value on that?
Yeah, around 60 million in assets under management. That includes both our rental properties, other assets, as well as our multifamily that we have under our. So certainly an interesting portfolio full of a consistent message of quality, attainable housing. So all of our units are in a concentrated area in the North Texas market with a focus on quality and workforce housing.
Quality and workforce housing. That sounds great. I want to get into what all those things mean and how you're doing right now. But first, I want to understand more about you, Jordan. So, what spirit animal or bird best describes who you are and Web City Properties as well?
Yeah, when you think of the tortoise and the hare, that's really where I always go back to, especially when you look over the last 5 years of this rat race to, the shiny object syndrome to the market growing so quickly, right? We are the tortoise that has been around for a while, and we're going to continue at the same pace moving forward, right? Because, we don't look at those other things around us. We look at our path and we look at our goals. And really, our message is long term hold, quality assets, quality renovations, good systems, good people, right? So when you do that, you're going to be that tortoise that may get run over by some of these hares that are coming on, but eventually at the end of the day, we're going to win the race.
So, would it be accurate to say your main operating principle in life is, even if you're walking slowly, walk steadily and towards the right goals and the right mission so you can build the right things?
Exactly. And I think too, run your own race, right? We're not a firm that is wanting to grow 1,000% every year. We're someone that is okay with slow, long-term growth that is healthy and has a focus for all of our employees to also be healthy in their work-life balance and for myself as well, while still building an impressive, steadily growing real estate operating company that can be successful and can treat our residents great as well.
Impressive and steadily growing indeed. So it just seems like you're currently at about 60 million in assets under management today, 500 doors in North Texas. But let's go all the way back to the start, back to zero, back to even before zero. What are some of the inflection points in your life that led you to where you are today?
Yeah, well, it really starts with my dad. I got to give all the credit to him. So my dad, John De Silva, he was an immigrant from India, came over here in the 70s. You hear about the rich dad, poor dad kind of cycle from reading that book into getting into real estate. He started reading similar books in the 70s and he started to realize, he was an engineer by trade at the time. He saw that real estate was really the way to build generational wealth. And for him too, he came from living in an impoverished background. He never knew this life would be possible. So for him, real estate was really that escape into understanding what could be possible. So he started doing that in California. Had a lot of ups and downs. Actually went bankrupt at one point. Broke off a business with his brother. A lot of turmoil there. A lot of lessons learned. But he took that and instead of just quitting, he decided to start another company, WebCity Properties. So that is how we got started. From the ashes of a lot of mistakes, we came out with a new focused model. And that was, I think the inflection point is deciding to go back into this, but also making the move from California to Texas at a time when the timing from 2007, when he sold out in California, to investing 2008, 2009, right during the crash and after, that timing could have been better. Certainly a combination of luck, but also being prepared to take advantage of that point. So from that point on, there's that inflection where he has great timing, gets into a great growing market. And then the third thing I would say is when he finds a model that works on two fronts. Nobody was wanting to invest in the areas he was investing in. You're talking about C and D class areas of southern Dallas. And then how do you make money in those areas? So most people would just do a quick flip. But for him, it was about how do we provide ownership access to people that don't have it and make a profit that allows us to grow a large cash flowing operating company. And how he did that was by buying a home, rehabbing it, and then seller financing it. So by doing that, you carry back the note and you're earning interest on that. The more times you can build that up, the more units you build up in that model, the more cash flow you generate over the course of time. And so doing that for 15 years in a market that is growing allowed him to build up a cash flow generating machine that was able to then flow into buying long-term hold rentals. And so when you have this dichotomy of both ways to provide quality housing for sale and for rent, that's really, he was able to find that model. And that was the inflection point for him to figure out, how do I grow this long term? And then obviously when he passed away and I took over, I've been so fortunate to have an existing great model that I've now turned more into this long-term rental, new construction. But it's all because of what he did at the front end by setting us up with an amazing cash flow generation machine that allows us to reinvest into our current opportunities. So that's kind of where we came from, where we're at now, and it's all thanks to his long term thinking, right at the beginning.
Wow. Yeah, Jordan. First of all, my deepest condolences on the passing of your dad, who clearly had an outsized impact on you and your life and your personality, as well as on Web City Properties. And seems like he had quite a journey from being a immigrant from India and not knowing anything in this country, and being an engineer, to learning about real estate. And seems like he started something with his brother that eventually didn't work out. But like you said, in the ashes of 2006, 2007, 2008, when things were really all right, he really found a innovative structure. I want our listeners to understand more about that structure. It's a for someone who is very naive, can you explain them what buying a home, renovating it, converting it into seller financing, and earning interest on it means in simple terminology?
For sure. So, when you think about the flip model, right, you're going to buy a home, let's say for $100,000, and you're estimating you're going to put in, let's say, another $50,000 to improve the property. Well, now you're in at $150,000. You've improved the property, and your goal is to sell it where you're making a certain margin that is worth your time. Let's say you then sell it for 200,000. You've made $50,000 on your money right then and there, and then your goal is to now take this $50,000 and do it all over again, right? That's kind of how the majority of the models work with the fix and flip, as they say in real estate. So with his model, it was more of it was two things. Number one is that by him offering seller financing, so instead of him buying something for $100,000, putting in 50 and then selling for 200, in this scenario, because he's seller financing it, and not only seller financing, but seller financing it to a buyer who cannot get a conventional loan. And so he's the only shop
He's the
in
back.
town for them, right? He's the only bank in town for them. So for them, it's worth more than if it was a cash sale. So instead of selling it for, let's say, 200, he's selling it for 225, 250. So he's making a bigger margin. And number two, because these are people, again, they have the income, but they don't have the bankability. Two separate things. You can have income, but not be very bankable, right? So if he's selling to this client who is not able to get a loan from a bank, they're willing to pay more and they're willing to pay a higher interest rate. And again, this is not taking advantage of anybody. I want to make sure that's clear. They have the income, but they're not bankable. There's a clear population of people in this country who have this problem where they have income, but they're not bankable, right? So that was his model. And when you do that, you're earning a bigger margin and you're earning interest over a long period of time. So that is more long-term income coming in to your company. Now
And
imagine you
which
do this 50
and that
times,
company
100 times
used
over.
yeah, exactly.
Exactly, exactly. So when you do that that many times over, and particularly, at the time, right, when 2008, no one wanted to buy. So like whatever your margins you're getting in 2024, I mean, 10 times, right, that you're getting in 2008 when no one wanted to buy. So just imagine that in your mind, a different way to do a fix and flip that is more focused on long-term cash flow generation through interest and through greater margin on the sell initially. So that was the model, and we're now the benefactor of that because of all that free cash flow that's just flowing that allows us to operate our business and to invest into assets today.
That's yeah, that's a brilliant model, and seems like your dad was really successful in scaling it. And if our listeners are curious about testing it out today, it's really hard to find these properties because really smart and thoughtful investors like Jordan's dad already did all that back in the day.
That's true. That is true. Yeah, we that's part of why we pivoted is because the model has not doesn't work as well today, right? It's just a different market cycle, right? Everybody wishes there was another 2008 in the sense that they wish they could buy at the bottom, but part of the reality of it is that a lot of millionaires were made in 2008, and we're not going to go back to that time. And I got to just be fortunate that he was able to take advantage of that in the right way, and we're able to be the benefactor of it. So it doesn't mean there's not ways to make money in 2024 and there's not opportunities to buy. It just means that now you have to be the one that has to be creative and think outside the box. But you
Yeah,
may
and I
not be
want
able
to
to copy from 2008, right?
yeah, I completely agree. And I want to get in more into how you're making money now. But I'm more curious to understand what was the story behind the company being named WebCity Properties in the first place.
Really, it's all goes down to the long-term vision of my dad, and a vision that is not yet into fruition, but one that we continue to pursue, which was when he was looking, you think about the Texas Triangle, and I'm sure you may have heard that term, and you got Dallas, you got San Antonio, you got Austin, you got Houston, right? You have this triangle of an area that, it wasn't like this in 2008, right? 2005, 2008, when he started growing this company, but he had this vision that we would grow not just in Dallas, but we would expand all across Texas into these markets where there you could execute this model. You could buy these homes, you could seller finance them, you could buy long-term rentals, and there was this overall message of Texas is a market that's going to grow, and there's multiple models in which to grow at, and at different times. I think the seller finance model was great then. The long-term rental play is great now, but Web City Properties at the time was this vision that we were going to be the one that could connect all these various dots across Texas. So it was really a message of investment in Texas. And now we're only in Dallas now, but it certainly doesn't mean that we won't eventually expand to other parts of Texas. So that is where the name Web City Properties comes from.
Fascinating. And what does WebCity mean in relation to the Texas Triangle?
Well, it's to connect the web, right? You're connecting
Oh,
the dots. So it's this web of areas that you're seeing a collection of growth that's happening all across Texas, but really connected by the Texas Triangle.
fascinating.
That's kind of, yeah, that's where web comes from. That was his original explanation a long time ago.
Yeah, indeed. So now, what does WebCity Properties focus on today? Which is, another way of asking, what are the opportunities of
Yeah.
real estate investing in Texas today, and how are you monetizing those?
Yeah, it's certainly a much different market. I would say a couple things. We're focused on long-term supply demand imbalance. That is, if I was going to say one message of our investment thesis, it goes back to the supply demand imbalance of quality workforce housing. Our single family rental side, that is what we're focusing on in the majority. The reason being is that, it is 50% more expensive to buy a home than rent for a single family home. You think about the taxes, you think about the insurance, you think about the interest rate environment we're in now. And so for people that are coming on and wanting to buy a home or entering those home buying years, it's very difficult and it will continue to be difficult for them. So what is the solution? Well, unfortunately, you can't build your way out of this. And why? Because the cost to build is just as expensive, if not more, due to labor prices, due to material prices, due to the cost of capital, right? All those things mean that those that are building new product are typically building for higher income earners, right? So where does that leave people that are that low to middle income that still want to access a single family environment, want to buy or own or live in a single family home, be a part of a neighborhood? Well, that's what we're trying to solve through our model of buying homes in areas that are growing but are still home to low to moderate income families that don't have access to quality single family housing. So our model is to buy homes at a basis that is extremely low because of their condition, do high quality renovations, rent them at higher than the current environment looks like in the neighborhood. So you're buying in an area where you believe in the long term growth and you believe that there are people that want to rent high quality homes. And so by doing a high quality finish, you are attracting a different middle to low income tenant that wants to live in a quality home, that will stay there for a long period of time, and that you get to provide a quality single family home experience to, likely for the first time for them if they're coming from an apartment or if they've been living in a very low quality single family home. So our thesis is that single family home supply demand imbalance is a chronic issue that's going to continue to get worse as we look forward to the next few years, and people just can't make deals pencil. And we're going to take advantage of that by accessing existing product that is dilapidated and vacant, and by revitalizing it in a way that attracts high quality long term tenants.
Fascinating. Yeah, I completely agree with your core thesis on finding properties with a supply demand imbalance. Supply being the supply of homes that are available to rent or buy, and demand being the demand of home buyers and renters who want to access that inventory. And as long as supply is lower than demand, which means the number of units available to rent or buy are lower than the number of buyers or renters out there, there's always going to be opportunity to invest in a great asset. So now let's double click into your current strategy, which is buying units that are slightly dilapidated, renovating them to the highest degree of finishes, and then renting them out to somebody who's more affluent in that area. One, how are you able to find these dilapidated units in supply constrained areas? And then two, how are you able to attract the right kind of tenants who can afford the rent that's higher than median rent in that area?
Yeah, great question. So first of all, on the buy side, we have a couple different ways. Number one, I would say, is through wholesalers. So wholesaler is someone that, you ever see the signs where it says "We buy ugly homes"? You probably got a mailer or a call from these people. They're annoying, no doubt, but what they do works, right? They are able to work to find owners of these vacant homes. A lot of times you have issues where maybe someone that had a family member pass away that owns the home, now they have control over it, or an older person who's wanting to sell it but doesn't know how to go through the process, and her home is in very poor condition. So a variety of reasons why somebody wants to sell a home quickly and easily. These are the people that get access to it, these wholesalers, and they want to know who can actually close in these areas and who can close fast, but also who's going to be buying the worst of the worst, right? We're the buyer, and they know us very well because we've been in the neighborhoods for over 20 years almost now. So when it comes to Southern Dallas, we're known as the guys that are going to be buying those types of homes. When you build that reputation that you're someone that is going to close quickly, that has the funds, that has the ability to execute, then they're going to go to you first. So that's our number one way of finding these deals. We have other contacts in the area that we buy through. Sometimes we buy portfolios as well through a broker network. So those are people that are more in the high level. Usually that plays in the commercial game, multifamily, but they also get access to some portfolio of single family homes that we also will buy. But those are the two main ways. We also have experimented with foreclosure auctions, tax auctions. There's a variety of ways that you can find these homes. But finding them at the lowest basis possible is the key, right? If you find them at that price, then that allows you the ability to do a high quality renovation. Now, to answer your other point about how do we find high quality tenants, and this is something that has really happened over the last few years that we've noticed, is because we were asking the same questions. We have a property in one neighborhood that, great school. It seems like it's got, next to a Walmart. It has all these great options, amenities, and then there's another neighborhood that, for example, could be in the highest crime zip code in Dallas. It can, not good schools, no amenities around it, and is going for the same rent as this other home that I mentioned earlier, right? So we were asking ourselves, why is that? It's the same tenant, and it's a tenant that is struggling to find high quality, condition wise, 3 bedroom, 2 bath homes. That particular floor plan, and this is actual data from one of the housing analytics companies here in the area, that they said the 3 bedroom, 2 bath single family rental home is the floor plan that has the least amount of supply relative to the demand for the product. So for every two people that want that product, there's only one home available for them. So that is our answer to why someone's willing to live in this neighborhood when, that doesn't have the same amenities as the other neighborhood. They're willing to pay the same amount of rent is because this is such a undersupplied, and not only undersupplied, but the quality is undersupplied. Typically in that neighborhood, the only types of properties you're going to see on the rental side is going to be these cheap flip homes. Even on the rental side that are, were more extensive renovation, no one's doing nice finishes, but they want to pay for those finishes. They want to pay for a nicer quality home. And those tenants, relative to the ones in the lower quality units that you have at a lower price, are actually going to stay longer. So you're realizing that if you target the most undersupplied floor plan to a tenant base that wants to stay for 3+ years, then it's almost like it all fits together. And you're like, okay, this is where I need to continue down this path. So that's really when our focus is, because we didn't always do everything. We didn't always target this tenant. We didn't always do the nicest finishes we could. It was only when we realized that this is the particular floor plan in proximity to Dallas that people were going to be willing to pay for, regardless of if it was neighborhood A or neighborhood B. So that really was what it boils down to.
Fascinating, Jordan. There's absolutely everything you said I agree with, right? From finding a niche strategy to target supply by building long-term relationships with wholesalers who buy homes for cash and sell them to you, to using analytics to find this niche demand, this 3 bed 2 bath 1500 to 2000 square feet range, which seems to be the entry level home for most, people who just started families or want to start a family or recently started a family. And yeah, it's a no brainer as to what you're doing. So the obvious next question is, how are you scaling this up while maintaining this high level of quality and sincerity? Like, how are you being a very thoughtful tortoise in this?
Yeah, and I think that goes back to the original point of, run your own race, grow to the size that you want to grow to. If we wanted to do 10,000 units this year, this is not the model to do it. It's not the model to do it if you wanted to buy 1,000 units this year. And of course, we have long-term goals of scaling and growing faster, but we also can do this at a subscale level that allows us to, create good returns for ourselves, for our investors, create impact. Where by being so close in the community too, you're creating, your market the best, you're creating more impact, you're a long-term holder, and you're growing at a pace that you're comfortable with, and that doesn't put stress or any unneeded stress on you or your team. We had the opportunity to talk to someone that wanted to invest, 20 to 50 million in what we do, and the amount of pressure they were going to put on us in order to do this model, and would put us outside of our comfort zone from a model standpoint, right? It would probably require us to do less quality. It would require us to make compromises on providing quality housing to our target demographic of people. So for us, we rejected that, and we are preferring to stay smaller and grow more steadily over time, while maintaining the level of quality and maintaining the same type of person that we want to have an impact on in our community and in our investment model. So that's really the answer to that, is that we have a long-term plan to scale, and this may not be the model that gets us to grow 100% every single year. And we're always looking for those opportunities. Don't get me wrong, but for where we're at in the market and where our company is at, we're okay with the steady growth that this model brings and the impact that it can have on the community.
I love that, Jordan. So, for investor listening into this and that loves this, what kind of return should they expect from you? What kind of check sizes can you take? And, what
Yeah.
kind of track record should they be aware of?
So our fund that we most recently launched is called the North Texas Workforce Housing Fund, which is really our way of taking this existing model that I just shared with you and putting it out to the market to allow outside investors to invest in it. And like I said too, we're not going after these $20 million check sizes. We want to go with people that are looking to make an impact, are looking for long-term capital appreciation, tax benefits, and stable cash flows over a long period of time. If that's what you're looking for as an investor, we're the perfect fit. And two, because we're intentionally staying smaller and growing steadily versus rapidly, we want to prioritize how we treat our investors and their investment experience. And any investor that comes on the team is suddenly is a priority because of our size and because of our ability to have that level of customer service and focus. So that fund is expected to receive 20% plus IRR over a 5 to 7 year period, with 6.5% cash flow every year to our investors, with a 10% preferred return, meaning that they will get 10% every year that accrues over time until us as the operator gets anything. So again, really focused on how do we take care of our investors first before we get a dime. And number one, we also don't take any fees except for on the sell. So you make the money through the cash flows, you make your money on the sell, we will make our money on the sell as well. So we don't make any upfront fees. It's all about how do we perform and then how do we sell in order to get great returns for you. That's how we reward ourselves, and that's how we align ourselves with the interests of our investors. So that's really the fund, going towards people that are able to make at least $50,000 minimum investment. It is a 506C, meaning we can only accept accredited investors for this fund, but we also have opportunities for non-accredited investors that will come in other ways. And the last thing I'll mention, as far as the track record that you mentioned, we have, over our history as a company, bought over 700 units. When you look at the historical IRRs, they look silly because it's stuff that was purchased at such a low basis. You have many properties that produce 30, 40, 50, 60% IRRs over time. When you look at our current portfolio, we're earning a 10% average annual return across the majority of our single family portfolio. For our multifamily, we're earning a 7% cash on cash return to our investors currently. And then we just gave an 8% distribution to our investors for our last investment opportunity, which was a 24 unit duplex single family portfolio that we purchased last year. So we're all about, making sure our investors get fed and get fed first. And we've shown that in our past, and we'll continue to do that in the future.
And for someone listening to this who wants to emulate what you do and get started with what you do, you're at a scale where you can grow and grow significantly, and you have a team of 10 really smart, seems like 10 really smart people around you that are able to
Yeah.
manage your portfolio of this size. How does somebody who's just getting into this get started? What's your advice to them?
Yeah, I think you first have to really understand why you're getting into this. We had to have the same conversation with ourselves in 21, 22. When I took over the business, I had to think to myself, because that first couple of years, you're kind of, your head is spinning, and the market was going so crazy. Everybody's supposedly making all this money, and so it's very easy to get unfocused and think, well, I should be 10xing every single day, right? It's unrealistic, and I think now, 2 years, 3 years later, we saw a lot of those people were not real. It was a lot of smoke and mirrors. So you gotta, in order for you to stay focused, you have to ask yourself, why am I getting into this in the first place? What is my investment goals? What are my lifestyle goals? If your goal is, hey, I want to live a pretty stress-free life and just have decent income that I can use to go take my family out. Like, if that's your goal, then you don't need to be going out and trying to build the next empire, right? There, you can actually look at, okay, how much cash flow do I need to generate through my real estate investments, and then solve for the lifestyle you want to live. So that'd be the first thing I would say is ask yourself, what do you want? It may be cash flow, it may be lifestyle change, it may be just capital appreciation while you're doing your own other investment or other W-2 job. But just be firm on that, and then look at the various ways that you can accomplish that. Do you want to be an active investor? Do you want to be a passive investor? How much do you want to do in this in arena? So once you have solved for those two things, then I think you have quite a few options to go through from there. I definitely recommend getting educated first and finding a mentor who has done this before, and somebody that is, there's going to be a reciprocal relationship for sure, but I would not recommend jumping right in and paying $10,000 for a mentor. Find somebody that is doing this in the space, build a real relationship where you can provide some reciprocity, but don't get take advantage of by just paying some random guy you met on the internet $10,000. So I've seen that happen a lot in the past. So that'd be the things I would say. Once you've figured out your strategy, you have a mentor, then get your feet wet, and then iterate. Right? If you don't like it, then it's never too late to adjust your strategy and move on to the next thing.
Absolutely, Jordan. And for an investor listening to this who's interested in digging deeper or learning more about this, how should they reach out to you?
Yeah, so you can just certainly contact us on our website, webcityproperties.com. That's WEBCITY properties.com. I'm also on socials at Jordan De Silva. So certainly reach out to me. I have my Calendly link on our website, and I'm always open to talk.
What else should investors know about WebCity that we haven't discussed already?
Well, I think my passion really lies with the social impact piece. That's part of why we do what we do, is the impact that we can have on our community and on our residents. So one thing I'll mention is that, we have a very specific impact thesis for our deals. Just like we have a investment thesis, we have an impact thesis. And for us, it's all about three things really. Number one, by buying the areas we buy and creating quality housing, we are not only adding more quality housing stock to the neighborhood, but we're cleaning up the neighborhood in a way that will improve overall outcomes. You think about crime, you think about health outcomes, you think about commercial investors wanting to get into these areas. They will feel more comfortable with more quality housing in the neighborhood. So for us, it's all about the long term building up of these communities. And then secondly, for us, it's about our impact on our residents through our management. So many management companies in this area, they look at these tenants, these areas as kind of throwaways, that they don't need to provide high level customer service, that this is the worst of the worst. When we look at it as an opportunity that we can be extraordinary in how we manage these properties and how we serve our residents. And that's a really specific part of the customer service that we're providing to our residents, is intentional to make their day better, to improve their lives, and to provide high quality service at all times. And we also do that through our patented resident services program. So we have partnered with a group called Rainbow Housing Assistance Corporation to provide resident services that will measurably improve our residents' health, education, and income goals. So we provide adult education, English as a second language training, we provide digital literacy work, financial literacy, as well as looking for rental assistance options for many of those that may be struggling with a medical issue that happened, or a large expense that they didn't expect. So all the things that we're doing, and we spend money for this outside of our own operating cash flow. All of it is because we actually do want to have an impact. It's not just words, but it's real action that has measurement behind it to show, are we having that impact, and how can we improve. So I think anybody listening, it's important to note that we're as strong on our impact side as we are as our investment side, and we believe when you can combine both of those things, that's really when you can do special work.
Fascinating, Jordan. And how do you balance the needs of, and the balance sheet costs of investing on the impact side versus delivering the highest possible returns from the investment side as well?
Yeah. Well, I think it all starts with the model, right? We have to buy it at a certain basis. We're not going out and buying it for market value and then still making it, this high quality home. We have to buy it at a discount, which does mean that you can't buy everything, right? But because of the areas we buy, and because we have a very focused buy box, it allows us to not get caught in distractions. We only buy this, and people know that we only buy this, and so we are fed these deals, and we're able to acquire that target because of our reputation. So that's number one. But number two, I think when it comes to cash flow, we are investing our own money that we get into our nonprofit, which then provides these services. So for us, it's not the investors. It never comes out of our operating, that any operating income that is supposed to go to investors is not going to be touched by the money that goes into the nonprofit, which then provides these services. So it is purely us taking a portion of our own money and putting it into the nonprofit to provide these services based on our mission and our goal to not only provide great quality housing and services, but part of the legacy of my dad, right? Of his impact. If I can if I can put money in his name to do great things, that will only cause his name to be, looked at in more favor, and people to know who he is and his story.
Yeah, that's incredible. From your strategy to really buying properties at a deep discount to their current market value, that is enabling you to do all of these other things as well. What is a typical discount to market value that you're buying these properties at? And follow up question is, for somebody listening to this that wants to sell a portfolio of properties to you, what is your buy box like?
Yeah, so we have to buy, anywhere from 15 to 30% discount, and particularly now, I think 30% is really more of what we need to hit, just due to the cost of capital, right? So 30% is typical discount, and that includes once you stabilize it. So, if you're buying something, I'll give you a real deal that we bought, right? We bought something for 65,000. right? I know that's you're from the Bay Area, so that doesn't sound like real numbers, but you're buying a home for $65,000. We're estimating that we're going to put in 130,000, essentially building a new home within an old home. That's what we're doing on this property, right? We're stabilizing it at, let's say, 195 to $200,000. This home will be worth 250 if we wanted to flip it, right? But instead, our goal is to hold it because we're buying it in an area that we feel great about, that we're getting stable cash flow from, and then if we sell, if it grows, let's say 3 to 5% every year, you're selling this for $300,000 in, let's say, 5 years. You're producing that great 20+% IRR. But to your other question about, I think you said the discount. What was the second question of
Yeah,
that?
then
Our buy box, yes.
yeah,
So
buy
our
box.
buy box right now is really from the single family side. We're only looking for homes that are either 2-1 that can be converted into 3-2. So we do a lot of additions to add in that square footage. So every time we buy 2-1, we're adding a one bed, one bath addition, making it 3-2, or it's an existing 3 bedroom, 2 bath, even better. So that's our buy box. We have a certain zip codes that we give our contacts. So that's focusing on Southern Dallas as well as Ellis and Kaufman County. Ellis and Kaufman County are the two fastest growing counties in Texas. So you have two fastest growing counties that are surrounded kind of below Southern Dallas. So you have Southern Dallas, Kaufman County over here, Ellis County over here. It allows for us to have some concentration, but still have a little more diversification as well in areas where the two of them are high growth, and then one is still a growth market, but more closer to that core downtown area. So it's a good mix of tenant base, but also of different growth metrics and growth engines. Right, Southern Dallas, the growth is coming from a lot of, I would say, the proximity to downtown and a lack of inventory, whereas Kaufman and Ellis County are recipients of a lot of outside investment into commercial, retail, and other population growth engines that are causing people to move to these areas. So all across the board, great markets that do have an inventory of these older vacant homes that we can buy. So that's really going to be our buy box. And again, I would say one of the things that makes it interesting is there's a lot of housing, even 3-2s, that is going to be that under that 1,200 square feet mark. So the smaller home that we can get, if we can do it between 900 and 1,300 square feet on average, again, better, the lower the better. If you can fit in that 3-2, the more efficient cost wise you can have on a renovation, right? We can have a 3-2, 1,100 square foot home that will rent very similarly to a 3 bed, 1,600 square foot home, but you cut off 500 square feet of that cost. And so that's really a big part of our model as well. So that's our buy box, would be that smaller product. Again, we'll buy anything under 1,500 square feet, 3-2 or a 2-1 that can be converted into a 3-2, and in the Kaufman, Ellis County, as well as Southern Dallas. On the multi side, we do buy multifamily. We buy all across the Metroplex, North Texas, but with a focus on heavy value add, where we can really make a difference with our renovation and property management capabilities. We do not buy anything that is already stabilized. There's just typically you're not going to see a ton of value to be made from that in this current environment. So we'll focus on that heavy lift that most people don't want to take on.
That's perfect, Jordan. Yeah, how does your team of 10 find these properties to buy, diligence them, or hire the right construction unit to either add square footage to them or rebuild them from scratch, like the unit you described, stabilize and rent them and do property management? Seems like you have quite an effective operating team. Can you dive into
Yeah.
that in detail as well?
Yeah, I mean, it's really all about data and repeatable processes. That is the two things I would say. So we have to know what our renovation cost is going to be at a granular level on both material and labor. When we walk into a property, we can know based on measurements, based on what we're seeing, based on our experience, what the cost of rehab is going to be. Because we only have 15 minutes, 20 minutes to walk this property. Then we may have an hour to go out and do our numbers. So we have to make an offer very quickly with limited information. But because we know these markets and we know these type of properties, and we've done so many renovations, we know exactly what our cost is going to be within a margin of error. We will make a bid that meets that. And of course, some of the bids are insulting, but it's just based on what our cost is. And if we get a deal, great. If not, move on to the next one. So that is our due diligence process for the single family side is very limited. It's really just about a process of walking through it, having all the data at your hands already that allows you to make quicker decisions and gives you the comfortability because let's say you walk into this and you're your range is 80 to 100,000 in renovation. Well, if your renovation turns into 100, but your deal still looks great, then you have that safety level. And that's why buying at a discount can save a lot of things. But it all starts with having that data from having done this work for so long, and two, having the same employees and same contractors for so long. That also adds in that element because they know their numbers, they know the processes, and so they can execute this. When we get under contract, it's like, it's a very seamless process of getting to close, getting our lender attached, doing the continue due diligence through that process, so we can really start the rehab once we close. Right when we close, we want to be able to start the rehab, and then even the rehab process, it's all divided into stages. We know which contractor fits which type of project the best. Some of your guys are great for the additions. Some of them are only good for maybe your lighter value add play where they're only doing, light finish out, right? So you have your guys, you know what they're good at. They know exactly the kind of materials you want to use, the quality standards that you have for them, and how you're going to manage them and the timelines as well. So if everything is documented, all the data is there, and the process is written and documented and repeated, then everything is, can be done in a very seamless fashion. Now, am I saying that's how it always works? Definitely not. I don't want to make that impression. The truth of it is that when you're working in these areas, when you're working on heavy gut rehabs and new builds, a lot of things go wrong. But the great thing is, the next thing that goes wrong is just another lesson that you add to your process, and then you improve it going forward. So we're constantly going through that iterative process of improving and, suffering new challenges that allow us to improve. But overall, I would say it's all due to the fact that we have gone through this so many times, and we have good data and we have good process.
Yeah, great data and great processes indeed. What's the biggest like challenge or bottleneck you're trying to solve right now?
Yeah, I think at the end of the day, like I said earlier, we have to find deep discounts. Otherwise, the deals don't work. So right now, deal flow is certainly one of the bigger problems. I would say deal flow and access to capital. It's just a tougher market to raise in as well for our fund, but that doesn't deter us. We have a lot of interest. I think it's finding the right investor. That's been the challenge, is finding out who is that right investor for us and who aligns with our mission. Not a challenge that can't be overcome, but certainly a challenge that I think a lot of operators are seeing in this current market. But deal flow is definitely a challenge. I mean, we're not going to, and part of that is why, growth is not going to be 10x this year, right? We have to find deals that make sense, and if they don't make sense, you're not going to be compelled to buy stuff that hurts the firm or doesn't make sense for your numbers. So we're continuously looking for ways to find better deals. It's always a challenge. I think most investors will tell you that's the biggest challenge right now, and many times, right, is just how do we find the best deals and don't become undisciplined because you're frustrated that you're not growing. That's and we're past that now, but it's certainly, sometimes you get frustrated and like, I want to buy that, but I can't make it work, and the numbers don't lie, right? The numbers don't lie.
The numbers don't lie indeed, and don't lose discipline if you're frustrated with lack of growth. That's a very strong tortoise versus hare mindset indeed, Jordan. Like we start, so ask you a couple of questions to coach listeners. What's the most biggest mistake that you see your peers in the industry making that you consciously avoid?
Yeah, I think and I've said this multiple times now, but it's such a true thing that I've seen so many people suffer from, including myself, over the last 3 years. Is don't get shiny object syndrome. Focus on whatever you're working on, whatever your path is. Stay focused on that, and as long as you have conviction and you know why you're doing it, and everything's aligned. You've done that planning process. Don't get distracted by other people doing other things, because half the time people are lying anyways, right? So you don't know what other people's journey is, and everybody's putting on a show for LinkedIn, everybody's putting on a show for Facebook to show their peers that they're, look how great I'm doing. But then the next thing you know, they're in the real deal, uh, an article saying so and so is getting their property foreclosed on, right? That's a real example of a guy that I know. That I went to a hockey game with this guy, and we're chatting, and he's telling me how great everything is going. I'm feeling, oh man, I wish I was like this guy. I mean, what a great success he is. And then literally 2 months later, I see an article about him getting foreclosed on 5 or 6 different properties. So you just never know what people are going through. You never know how great a deal is doing. So don't let other people distract you and lead you off your path. and your goals for your life and how real estate affects that. So that's the number one thing. It's very simplistic, but I'm sure you've also seen the same thing. There's a lot of peers that can get distracted by being jealous and not just staying on their own path.
Completely agreed. And on the philosophy of not getting distracted and not benchmarking against your peers, my philosophy is that unless I'm willing to change my entire life to their life, I'm not going to compare the
Yeah,
positives of their life with the negatives of mine. Right. So,
that's exactly right.
finally, if your loved ones agree to be mentored by you, what's the most important skill that you want to teach them?
Yeah, I think you know the deal analysis part is something that I think a lot of people struggle with is not just deal analysis, but how do I get my investment thesis? Like, what does that look like in real time? So, for us, it's taken time. We didn't wake up and think that buying 3 bedroom, 2 bath homes, gut homes in southern Dallas was, the best thing we could do. It took time, it took data, it took research, it took collaboration, and it took being in the market and really understanding a lot of the variables. So there's certainly a process by which you can do this, and I'd love to talk to people about how they can develop that process for themselves, whatever market they're in or whatever asset class. The second thing I would say is, I'd love to teach people about impact. There's always ways for you to utilize either yourself or your company, real estate as a whole, to create impact. And that's something I'm very passionate about. Obviously, what we've done for our company. And I think it can be done for many other operators in the space, other investors. And I think if they did that, and if more people did this, we would see a lot more positive impact on communities.
Jordan, couldn't agree with you more. In fact, one of the reasons I started my company as well was to focus on real estate while making a strong positive social impact. So, guess that was Jordan De Silva. If you want to invest in properties in Dallas that get you a competitive return, or if you're selling a property under 1,500 square feet, 2 bed 1 bath, or 3 bed 2 bath in Southern Dallas, Ellis County or Kaufman County, reach out to him through webcityproperties.com or Jordan De Silva on socials. If you want to talk about real estate anytime, shoot me a note on nick@home.llc. Thanks, everyone.